All right, today we're doing something a little different. We're not just looking at economic history, we're going to conduct a full-on forensic investigation. We're going to dig into how a single nation got hit by one financial disaster after another, and how it not only learned to survive, but actually came out stronger on the other side. Okay, let's get into it.
So that's the big question, right? How does a country even begin to recover from three, not one, not two, but three absolutely devastating financial crises? Mexico's story isn't just about things collapsing. It's this incredible story of resilience, of adaptation, and about some really hard-won lessons that completely reshaped the country. And honestly, they offer a ton of insight for the rest of the world.
Okay, take a look at this. This chart, this is our key piece of evidence. It's basically Exhibit A. It tracks the Mexican peso against the US dollar over 30 years. And every one of those sharp, terrifying drops, well, that's a crisis we're about to investigate. But that jagged climb back up, that long period of stability at the end, that's the story of resilience we're here to figure out.
So why Mexico? Why are we focusing here?
Well, because its history makes it the perfect, and I mean perfect, laboratory for understanding financial crises. It's like we get to watch these completely different types of economic disasters play out in the very same country, one after the other. And we have three really distinct case files to look at. First up, you've got a sovereign debt crisis back in 1982. That's when the country itself literally couldn't pay its bills. Then, the infamous twin crisis of '94, which was a currency and banking meltdown rolled into one. And finally, the big one, the global shock of 2008, which was the ultimate test of all its newly built defenses.
And this is why this whole story is so incredibly valuable. We get to see this crystal clear before and after picture. I mean, Mexico literally transformed itself from a system with a fixed currency and really weak institutions to, well, the exact opposite. And that transformation, that's the core of our investigation today.
Okay, let's open our first case file, the 1982 debt crisis. The best way to think about this one is as a story of a nation's solvency just breaking. This was a debt bomb, and it had been ticking for years, and in '82, it finally went off.
Now, to understand the explosion, you have to look at the setup in the 1970s. Mexico was making a series of absolutely massive bets. It was borrowing huge amounts of US dollars, basically gambling that high oil prices would last forever, that global interest rates would stay nice and low, and that foreign banks would just keep on lending them more and more money. And for a while, this high-risk strategy actually worked. Until, of course, it...
And then, this, August 1982. The music stops. The government has to go public and tell the entire world that it simply could not pay its debts. The bet had failed, the crisis was on, and it sent absolute shockwaves through the entire global financial system. And what happened next was this just catastrophic domino effect. First, the US jacks up interest rates, which makes Mexico's debt payments explode. At the exact same time, oil prices crash, wiping out their main source of income. Confidence just vanishes. Money flees the country, the peso completely collapses, inflation goes through the roof. It all ends with the government taking over the entire banking system, a total meltdown.
So what's the big lesson here? The really crucial point from this first case is this. This wasn't just a temporary cash flow problem. Mexico wasn't just illiquid, it was insolvent. There's a big difference. It had borrowed tons of money in a currency it couldn't print, and when its income vanished, it was fundamentally, completely broke.
All right, on to our second case file. This is the one a lot of people have probably heard of, the 1994 tequila crisis. Now, if that first crisis was all about solvency, this one was all about credibility. It's a story of how confidence, once it's shattered, can bring an entire economy to its knees.
The scene in the early 90s could not have been more different. Mexico was the absolute darling of the emerging markets, a real poster child for reform. NAFTA had just been signed, state-owned companies were being sold off, and foreign money was just pouring in. But, and this is a huge but, there was a hidden vulnerability, a sort of Achilles heel. The peso was pegged to the dollar, held in this tight little band by the central bank, and that peg was the system's single point of failure.
And you can see what lit the fuse right here. A series of really jarring political shocks in 1994. A major uprising in Chiapas, a political assassination. It completely spooked investors. They started yanking their money out fast. And you could see the central bank's reserves of US dollars just plummeting as it desperately tried to defend the peso's value. It was truly a perfect storm.
So when the government finally gave in and devalued the peso, it just unleashed this incredibly vicious cycle. All of a sudden, anyone with debt linked to the US dollar was in massive trouble. This, of course, caused even more capital to flee. To try and stop the bleeding, the central bank had to spike interest rates, which just crippled the economy and the banks, leading to a horrible recession. It wasn't one crisis. It was a currency crisis and a banking crisis all at once.
The lesson here was absolutely brutal and crystal clear. If you try to fix your currency's value, but you don't have the credibility or the massive pile of cash to back it up, it's basically an open invitation for markets to come and bet against you. And in 1994, the markets won. Big time.
Okay, let's move on to our final case file. 2008, the global financial crisis. Now, this wasn't really a Mexican crisis, but it was the ultimate stress test for them. It was the final exam. A chance to see if all those painful lessons from 82 and 94 had actually resulted in a stronger, more resilient system.
Now, it's really critical to get this. This time, the storm came from the outside. The problem started in the U.S. financial system and then spread everywhere as global trade just collapsed. And that fact makes Mexico's response a true measure of its internal strength, a strength it had to build from the ashes of its past failures.
So, what happened this time? Well, this slide shows the system bending, but crucially not breaking. Over on the left, you can see the new defenses doing their job. The flexible floating exchange rate took the pressure. It acted like a giant shock absorber. They had huge reserves that gave the market confidence, and their new strong banking rules prevented a domino effect. Now, it wasn't painless. Look on the right. GDP still fell hard and credit got really tight. But the core of the financial system actually held.
And this right here, this is the punchline. This time around, no banking system collapse, no default on government debt, and no need for a giant emergency international bailout. All of the catastrophic consequences from the past, they were completely avoided. It was a totally different outcome.
So the final lesson here is maybe the most important one of all. You can't always stop global storms from hitting your shores. It's just not possible. But if your institutions are strong, if your policies are sound, and if you have that credibility that you've earned over time, you can make sure the damage is contained and that you can recover.
Okay, so let's put it all together. Let's synthesize all the evidence from our 3 case files. Because when you put these crises side by side, the evolution of Mexico's economy becomes just incredibly clear.
I mean, this summary table really tells the whole story, doesn't it? Just look across the columns. In 82, you've got a fixed exchange rate, dollar debt, low reserves, weak regulation, and the outcome is default. In 94, a fragile peg in dollar-linked debt leads to that devastating twin crisis. But by 2008, a floating currency, mostly local debt, huge reserves, and strong regulation, and the system is able to absorb the shock. The contrast is just stunning.
Mexico's journey really proves that economic resilience isn't something a country is just given. It's something that has to be earned, usually through really painful experience. And it leaves us with one final crucial question to think about. As we look at the global economy today, where are the hidden vulnerabilities? Where are the fragile currency pegs, the unacknowledged debts, and the shaky points of confidence that maybe, just maybe, we're all ignoring?